También. Ya mismo. Fuori la luz, maestro. Bueno. Mañana. Okay. Kuni still living como kuch bata kamu kan? Oh. No. Aku go first. Yes, the man go first. Daddy. Yes. Hello. Yes. Tambah. Ya, kombi, untuari. Gimana ini? Gimana? Bisa? Bagus. Yes. From the nyumba kudimu. Umeshandaga mwenyewe. Oh. Tunamaga kuna jema kono kabena kota chali. Quindi come una video hormone kazi. No. Kabuda yeye ndio budisi na moyo wewe. Wengine kali sana kati ya mjino wao. Bene, nipi vedi che devi vegliare na bliga crede ni. Basi, vedi madai kuli tidak dinul. Yes. Yeah. Case when man you see this very same behavior. I have some knowledge. Okay, I think I'll call you during the day. Alright, sure. Yes, machine.
Yes. Mbona nashinda kweli?
Nani unaona kama video?
Nimo kwa kuda.
Na kama ni Juvenal. Good. Yes, Giovanni. What do you have with one of them?
we are studying a new topic, and our topic is receivables. Receivables. So you have classification for receivables and uncollectibles receivables. Alright, if we start, what are receivables? Any idea? Yes, you want. What are receivables? Anything up? Receivables, market.
We are yet to receive from them.
We have to see it from there. How do we report them? We report them as what? Expenses. How? And where are they reported? Receivables. We are there, okay? Yes, Yvonne. What are receivables? Receipts. Where do we report them? Or how are they reported? Marcus, are receivables really expenses?
Of course, they are not
Oh, what are examples of receivables? Probably experts from there.
examples picking up.
Alright. Let's go back. So when you talk of receivables, from what you have said, you are very right. You look at over there, the money that the business looks forward to receive, but it does not get what? Received. So this receivable, the situation where we see the business having money to correct from whosoever is owing the business, definitely such kind of stuff may come into existence if there is what? A credit sale. A good example, let's say the customer goes to a business or comes to a business and has a goods without paying for those goods. Definitely, what we do is that now the customer is what? Is owing us. And he is the data. So a great example of accounts receivable are what? Data. Right? So we talk of these accounts receivable, when it comes to reporting, they're reported as assets. Specifically, they're reported as what? Current assets, and they're reported in the balance sheet under current assets. So the way these receivables come into existence, just as I've already said, we look at where a credit sale has been made, and so that we have the credit sale being made, we look for that at one time or the other, we should be able to settle such kind of sales. So when it comes to classification of all these correct codes, you'd have like data not receivable, accounts receivable, and all those kind of stuff. When we talk of accounts receivable, just as data is a part of the accounts receivable. When we talk of non-receivable, it will also be data, but in this case, under the non-receivable, we look at a situation where those who are owing the company, they give what? They give a notice to say the amount that we are owing you, we should give this amount on such kind of deals. We there, right? Alright. So let's start. So you write introduction. So under the introduction, you write this. Under the introduction, write this. Sales are made on cash or credit basis. 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 Full stop. When sales are made on credit basis, when sales are made on credit basis, when sales are made on credit basis, that is, funds will be collected later. That is, funds will be collected later. That is, funds will be collected later. Comma. The amount to be received, the amount to be received, the amount to be received, the amount to be received is recorded in the account receivable ledger. The amount is recorded in the account receivable ledger. Is recorded in the amount receivable ledger. And a record for each customer is held separately. Is held separately. And the record for each customer is held separately. Is held separately. Are we there? Is held separately. So, write classification of receivables. Classification of receivables. Classification of receivables. And under the classification, first classification, you write accounts receivable. Accounts receivable. Accounts receivable. And under accounts receivable, you write this. The most common transaction creating a receivable. The most common transaction creating a receivable is selling merchandise or services on credit. Is selling merchandise on credit. The most common transactions creating a receivable is selling merchandise or credit service. Selling merchandise or service on credit. First of them. The receivable is recorded as a date. The receivable is recorded as a debit. The receivable is recorded as a debit. Is recorded as a debit. Is there? Recorded as a debit to the account receivable account. 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 Full stop. Such accounts receivable are normally expected. Such accounts receivable. Such accounts receivable are normally expected. Such accounts receivable are normally expected. Such accounts receivable are normally expected to be corrected within a relative rate. Expected to be corrected. Are expected to be corrected. Are expected to be corrected within a relative rate short period. Within a relative rate short period. Such as 30 or 60 days, such as 30 or 60 days. Also, they are classified on the balance sheet. They are classified on the balance sheet. They are classified on the balance sheet. They are classified on the balance sheet as current assets. So just as I said, you look at Mongol is meaning Mudori as a company within the period that have just been specified in what we've just written. Then we go to the other, we talk of not receivable. Not receivable. Did you hear what I said on not receivable as I was introducing the topic? Alright, so we have this. So not receivable, not receivable, not receivable are amounts that customers owe. Not receivable are amounts. Not receivable are amounts that customers owe, for which a formal written instrument of credit, has been issued. Formal written instrument of credit has been issued. Full stop. As long as not receivable, are expected to be corrected. As long as not receivable are expected to be corrected within a year, they are normally classified. They are normally classified on the balance sheet as a current asset. We'll stop there. Notes are often used for credit. Notes are often used for credit. Notes are often used for credit. Notes are often used for credit periods for more than 60 days. For more than 60 days. Can use for credit period for more than 60 days. For more than 60 days. Full stop there. For example, a furniture dealer a furniture dealer may require a down payment, A furniture dealer may require a down payment. At the time of sale, and accept a note, or a series of notes, for the remainder. Full stop. Such arrangements usually provide for monthly payment. Such arrangements usually provide for monthly payments. Full stop there. For example, if you have purchased furniture on credit, if you have purchased furniture on credit, you probably signed a note. From your viewpoint, the note is a payable. From the trader's viewpoint, the note is not receivable. Full stop. Then I already done that side. Yeah, there, right? So you write the last, that's number 3. You write other receivables. So you write, and other receivables are normally listed separately. Other receivables are normally listed separately. On the balance sheet. Full stop. If they are expected to be corrected within a year, they are expected to be corrected within a year, they are classified as current assets. If correction is expected beyond one year, they are classified as non-current assets. non-current assets and are reported under the caption investments and are reported under the caption investments. Under the caption investment. So, other receivables include interest receivable, taxes receivable, and receivables from officers or employees, Is that right? So, just as you said, you can say this money, the business is looking forward to collect. So they have that hope that the money will be collected. But with experience, you know that not all accounts receivable are collected, right? Sometimes the business fails to collect the amount that their customer owes them. So if the customer has failed to collect the collectibles, they become uncollectibles. And if it's totally going to be collected, you label that as what? A bad debt, right? Where do you report bad debt? And bad debt are called as what? Matthew?
Because it's, I think, they're more like income that we refer to collect from there, that order.
So you report them as, where do you have to report bad debts? If one. So bad debt is an expense. Do you remember that? Because it was looking forward to collect that amount, but due to whatever reasons are there, the money has failed to be collected. So the fact that the money has been failed to be collected nearly tells on the business point of view or on the business part, and it will report as errors. So we'll try to say how best do we report or how best do we account for uncollectibles. So uncollectibles may not exist if they are collectibles. So a bad debt comes later once you have uncollectible, or once you have customers owing you, customers not paying you with their right. So you write uncollectibles. So, and the uncollectibles, you write a major issue facing companies, is that some customers will not pay their accounts or debt. Is that some customers will not pay their accounts or debt. Customers will not pay their accounts or debt. Full stop. That is, some accounts receivable will be uncollectible. So in this case, we are talking of this. Uncollectible UN. Will be uncollectible. So can write down. Many retail businesses may shift. Many retail businesses may shift. Many retail businesses may shift the risk of uncollectible receivable. Many customers may shift. Many customers may shift the risk of uncollectible receivables to other companies. To other companies. For example, some retailers do not accept. For example, some retailers do not accept sales on credit. Some retailers do not accept sales on credit, but will only accept cash. Or credit cards. Will only accept cash or credit cash. That is to say, in this case, you find that businesses, in order to avoid the uncollectibles or in order to avoid bad debts, they will totally put it as a policy to say, if you go to buy from them, you need to go with them with what? With cash. So that policy is like, you don't want to have a bad where you have your customers failing to pay you, but you'd rather have the system or the cash and carry system, right? You know what cash and carry means, right? Give money, take what belongs to you. So, to proceed there, you write, as Mark Lanning, something like that, as Mark running or Lennon, as Mark Lennon 2008, Mark Lennon 2008 companies may also sell their receivables. Companies may also sell their receivables. Companies may also sell their receivables. Companies may also sell their receivables to other companies. Full stop. To other companies. Full stop. This is often the case. This is often the case when a company issues its own credit card. 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 For example, Massey Holding Corporation. Massey is a company. M-A-N-C-Y. Massey Holdings Corporation. Massey Holdings Corporation. And J.C. Penney issue their own credit cards. Selling receivables is called factoring. 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 The receivables. It's called factoring the receivables. And the buyer of the receivable is called the factor. And the buyer of the receivable is called the factor. Also, an advantage advantage of factoring is that selling its receivables receives immediate cash. Selling its receivable receives immediate cash for operating and other needs. Full stop. In addition, depending upon factoring agreements, some of the risk of uncorrectable accounts may be shifted to the factor. Full stop. Full stop. Regardless of the care used in granting credit, the correction procedure used, a part of credit sale, will not be correctable. Full stop. The operating expense record from uncorrectable receivable. The operating expense recorded from uncorrectable receivables is called bad debt. Uncorrectable accounts expense, or doubtful expense. You will skip a line and like this. When does accounts or not become uncorrectable? When does an account or not receivable or not become uncorrectable? Question mark. Then you write, there is no general rule to determine. There is no general rule to determining when an account is uncorrectable. There is no general rule for determining when an account is uncorrectable. Full stop. Once receivable is past due. Once receivable is past due, a company should first notify the customer. Once a receivable is past due, a company should first notify the customer. And try to correct the account. Full stop. If after a repeated attempt, the customer doesn't pay, the company may turn the account over. The company may turn the account over to a correction agency. What will the matter? The correction agency. We are machine. Now. So sometimes you know the sheriff, right? Okay. What they're doing? Let's say if the company or the customer fails to pay, I'm not sheriff. The government they are mobiliar. Straight it up. Let's take our institution as got loan with others. If they come here, they'll correct the most valuable aspect of the institution where they feel they can get their money back. Is there, right? Alright. We proceed here. After the correction agency attempts correction, any remaining balance in the account is considered worthless. Any amount remaining in the account is considered worthless. Full stop. Is considered worthless. Full stop. One of the most significant indication of partial or complete uncorrectability. Occurs when the data goes into bankruptcy. Alright. So, as we have said, what we normally do in this case is that the fact that we have known who are the customers that we feel they may not be able to pay, or we have completely failed to correct the money after all the attempts we have had, or after all the attempts that the correcting agency has done. Now what we do is we need to write off that uncorrectable. And by saying we need to write off that uncorrectable, during Tikangani to withdraw that into our books of accounts. And once we have removed that amount into the books of accounts, if you consider it to the company, that the company has made what? Has made errors. We there, right? Now the company has actually made a loss. So let's write method for accounting for uncollectibles. Method of accounting for uncollectible receivables. Uncollectible receivables. Have we heard of this before? Have we heard of how we account for uncollectibles? Yes. Yvonne, how do we account for bad debts from our accounting courses? Have we done such kind of stuff? Alright, let's try this. Right, there are two methods of accounting. There are two methods of accounting. There are two methods of accounting for receivables. Of receivables. That appear to be uncorrectable, and these are that appear to be uncorrectable, and these are direct write-off method, and these are direct write-off method, and the allowance method.